Will there be a repeat of the GME squeeze this year? Maybe. We'll go into all the catalysts leading up to the possible Moass, and at the very end, we'll show you how we are playing it. So, Justin, let's roll right into it.
So, quick refresher for everyone right here. This is what everyone pretty much talks about when they think of GME. This was late January of 2021. This is basically PyFi's chart right here, what he's talking about. And I want to call, Josh, your attention to kind of three things right here. The first thing you see is the option cycle. And this is something that probably most people following with this channel will know. And it has to deal with how option market makers, particularly those who have sold long-term contracts. So these would be contracts sold over the past year for beyond January or maybe expiring in January, how they have to manage their delta hedging so they don't run into a potential gamma squeeze. But those are the two things right here. These are these ETF leaps and these GME ETF leaps for that. The second component is from COMEX, and I'm very weak on my understanding here, but one of the things that we've seen in the past is that there's this like this basket of stocks that don't really seem to have an immediate correlation, but they move in lockstep with one another. I don't know how to square this circle, but the best explanation I've read so far is that there perhaps might be a COMEX product, like a COMEX basket that people are going short. And in going short this basically allows people who go short this COMEX basket to get the underlying equities of whatever they are.
Yeah, sell those back. He's talking about like Bed Bath & Beyond, AMC, GME, and like CO. With that, like with these completely uncorrelated stocks, why is it that they all move the exact same together? The only realistic explanation that we've come up with is that people are making a synthetic ETF with just these stocks, and then they're shorting them. With that, you don't have to report your shorts on the individual companies, and you get to actually artificially prop down these stocks without anyone really knowing.
Yeah, it's very, very opaque. And like I said, I mean, I'm sorry to the viewers, of course, because I wish I could talk about this better, but I just can't. But what's interesting is that when you think about this is the best way I've come to mentally internalize it. Remember, like, when you're playing a video game or whatever, right? You've got to shoot the boss, and the boss has his shields up. Every like 30 seconds, the shields go down. You can, shoot the boss, and the shields go back up again, for the next 30 seconds, whatever. I think that the same thing, in a sense, is going on right now with these COMEX future cycles, where like on a quarterly basis, they have to kind of square up their books, and so they become vulnerable, or at least they become vulnerable from this angle, and that creates an issue. And last thing here on the very bottom, FTD stands for failure to deliver. Just a quick note about that. Market makers, in conducting bona fide market making activity, have the ability to sell naked short stocks. In other words, if you think you're buying a stock, you might be buying an IOU of a stock from a market maker. The reason this is allowed is because it's designed to provide liquidity to the market. So there's always someone to make the market. Now, there are rules of when these have to be closed out. And generally, kind of the rule of thumb that I use is about 35 calendar days. So I'm kind of glossing over some things as I poorly understand it. But the point is that once you start, or once you issue an IOU share, so that's a market maker issues an IOU share, there's a hard timer of 35 calendar days. And so they can kick the can down the road, but they can't kick the can down the road beyond that. And what's more, there's some other limitations that come from this. But the point is, you just want to remember this number, 35 calendar days. Keep it in the back of your head. And it's both for GME, the actual underlying, as well as for the various EFTs that might hold GME, like XRT, I think it's the retail one. GMR is another one. One of the things that PyFi has mentioned is, over the past few days, and starting last week, you've seen some really, really weird stuff going with GME. And you can see in the very bottom of the screen right here, the volume is 100 to 500% of the 3-month moving average. You had significant retail purchasing, not just over the past month, but over the past year. And of that retail's been directly registering their shares in their own name, pulling them out of the DTC's common ownership pool. You've seen a massive bump in dark pool volume. Citadel, a major market maker and perhaps one of the villains in this story, just got what was it, yesterday, Josh, or earlier today, it was announced, $1 billion and change inflow of capital, fresh capital.
Yeah, about 1.5, and they do not often do that. And the only thing that I find kind of weird is during this time, we've seen nothing but increased dollar liabilities. You would think that these guys are doing absolutely fantastic. So why would they take this on when they never or often do not in the past? That is definitely something to consider. It's just, we'll just state it now.
Yeah, and last Thursday there was a very odd spike after hours where the price ran. What was it, like $30, Josh? It went over like 170.
30%.
Oh, yeah. I mean, it's really bizarre. So the current theory for that after-hour spike is that it was basically designed to bump up the. Josh, help me with options here. It's the variability pricing option. They're trying to price retail out.
Basically, it's going to artificially prop up the price of the options.
Yeah.
You don't need the price of the options to go up for market makers to jack up the premiums on these options. If you just go on the option chain, I mean, you're paying like thousands of dollars per contract, which is just absolutely insane for a stock at the price it is. The only explanation is these option makers, when you've been, how do I say this, slightly fucked before, like in the last GME spike, option makers, they do not want to be fucked again. So what they are doing is jacking up the premiums on these options to disincentivize retail call option buying, because that's really where they went wrong the last time.
Yeah.
So even if it does go against them, they're getting such high premiums, it's worth it.
Yeah.
But unless, and this is a big caveat, and unless retail says, I don't care what the premium is, I'm still going to buy these options, then they will be in for a unholy world of hurt.
Yeah, pretty much like PiFi's big thing is that it's up to retail to buy options, but not just any options, to buy kind of at least at the money, but very long dated call options. And the point is you're trying to put a delta weight onto the option chain. Because I think what happened last year was that you had the option market makers who were because remember, so last year, like GME, or excuse me, 2020, GME was like what, like $3? Like it was a joke. I mean, I can't remember what it was all the time, but it was a joke. And so the thing is, when they opened up the option windows by the end of 2020, at least into January, every single option on the option chain for like January and February was in the money, essentially. And so that basically meant that the option writers had to go in and they had to basically delta hedge and had to buy a metric, crap ton of shares. This, jacked the price up. And when people cast settled the options, this removed the pressure from the options writers. They were able to sell the shares until the price crashed back down. So the big theory this time around is that if retail FOMOs into long dated options, this will add delta weight to the chain. And if retail demands delivery, or just let's say a cashless exercise of the option, that is to say, okay, listen, a broker, I want you to exercise my option, debit my account, however many tens of thousands of dollars. And then once the shares come in, you're authorized to immediately sell however many shares you need to, pay back the loan to do, or the cash you front of you to do in the first place. But anyways, the point is that when you add when you buy long dated call options, this adds delta weight to the chain, which means the people who wrote the options have to go in and start buying the underlying of the thing. This causes the price to go up. If you already have an illiquid stock because retail's been buying and registering for the past year, this is going to be problematic because
and by registering means direct registering the shares. And if this stock is shorted to the extent which Justin does, that's going to lower the liquidity pool for these option makers to collect the volume that they need to transact with.
Well, what's going on, here we are right here. So what's going on right now is that, forget like retail buying long dated at the money call option. Just forget that for 1 second. You basically have these three things that are coming in right here. And by the way, if it's hard to read, just check out the link in the comments below. You can pull this up yourself. But the key thing is that you have all these various things, and particularly this around here. This is the COMEX. This red triangle right here is the COMEX failure to deliver from that facility. The blue ones are the failure to deliver from the ETFs, and you can see right here, the other various things that are coming up here. But the point is, without retail even touching options, there's going to be a massive, there is believed to be a massive amount of buy pressure that's going to be coming in for GME. This is against the backdrop of retail starts again FOMOing and buying long dated call options. It's going to force the market makers who write the options in the first place to hedge what they write. This means that in addition to the people who are short through the various schemes and tomfoolery options out, or excuse me, the various schemes that people might be short, you now have these people who have to put pressure on buy because they've got to manage your short position. So that's on one side. Then on the other side, you've got the option makers, the option writers, who are being forced to go in and basically buy things. And so you're basically using option writers as a bludgeon to bludgeon the people who are short. And at that same time, this basically just forces the price to go up. And if people start exercising these options instead of cash settling, then you essentially have, I guess, and if the people who are writing the options aren't managing their delta risk correctly, then you're looking at a gamma squeeze or a gamma ramp, I think what it's called. The point is that like you get this, positive feedback loop.
And this is all like, this is not people making decisions on a daily basis. This is just an algorithm that says that for these market makers, there's not someone trading on the other side of it. It's just an algorithm just automatically filling orders. So this isn't just decisions being made. If when you buy a call and these option makers are taking the other side, so they're selling that call, if your call expires in the money, these guys are continuously delta hedging. Now they're stuck short 100 shares. So what do? They have to buy call options or start buying up shares to stay delta neutral, because they're not making their money from picking a direction. They are simply taking the other side of every trade and getting a tiny spread, which if you're doing billions of transactions a day, it's extraordinarily profitable. But like, let's go back to LTCM. They had a perfect algorithmic mathematical equation on paper to look perfect, except one thing: they didn't take into account that Russia could potentially just default on their bonds. Maybe these algorithms, they're just making decisions not based upon reason, but just pressing the button. Maybe that exact same thing could happen now, and theoretically, the stock could go to infinity, and there would just be a cash settlement from the government. That is, I'd say, Justin's main thesis, something like that.
Yeah,
so it is an absolute possibility, but by no means a certainty. And now let's go into how we are actually playing this, because if you've been watching, I've been very, very skeptical about GME, and I've given a lot of pushback on past videos. You can check those out. But I see a lot of smoke, and as Justin says, when there's smoke, there's often fire. So I am playing around with a few options myself, just to see how this plays out, because if it does happen, it will be one hell of a ride. So for myself, there was a massive dip yesterday where I got an option going out a few months, pretty far out of the money. My plan is to buy one more option. I mean, the option premiums are very high, and this is pure speculative money that has a potential to 100,000x if certain variables play out. So I think, why not put a few grand? If that is too much money for you, then you honestly just shouldn't be playing in the market. As fucked up as it sounds, that's just the way it is. So if, let's say, this Moass, quote unquote, does happen and the stock is absolutely ripping, I will sell one of the options and then take delivery of the other, which would give me 100 shares to play with, and
and maybe more.
Yeah. So well, that's how I'm playing it. Justin has a extraordinarily larger position, as he has been bullish for a long time. You can look at our past videos, and he's been riding this wave down, continuously buying. But so Justin, how are you playing this?
Playing it one day at a time. Just as a quick point of precedent, this is the VW squeeze that happened back in 2008. And what I want to call your attention to is, you can see my cursor, right here. There was this massive smackdown just before the rip. And so the funny way to say that is the dip before the rip. I don't know what's going to happen this time around, but I would not at all be surprised to see GME go down. I also wanted to add this too, Josh, is that when you see again, as a pro understanding, the various mechanisms that the market makers are using to manage your short position, they're very prone to volatility. So the point is, as volatility increases in the underlying, so if there's not a lot of liquidity and people are forced to buy, that is, large people are forced to buy or sell in either direction, it makes the mechanisms that manage the short position much harder to control. So kind of the way I see it for myself is kind of, you took words out of my mouth, where there's smoke, there's fire.
How are you playing this? With what mechanisms?
So I do have, I guess, a decent position of the GME shares that I've directly registered in my own name. So that's that. But I also have a fairly decent option position, and I'm looking to increase it. When it comes to options, I have just found that my ability to time this stuff is atrocious. So the options that I buy is, I buy January 2023, and I just pay through the nose for it. And And I realize I paid through the nose for it. But my plan would be, if this thing starts taking off, kind of to take a page from what you just said, Josh, I would seek to exercise as many options as I possibly could. I don't know the MO of how I'd
take delivery,
exercise.
correct?
Take delivery of it. So depending upon your broker that you use, this is probably a phone call, but the point is brokers have various ways that if you do, let's say, are relatively cash poor, but option rich, I guess, there's ways that you can exercise the option and the broker will basically front you the cash. It's going to kind of vary by broker to broker, but no pun, options do exist for that. So that's kind of what I'm planning on doing on that front. I do have some very, very far out of the money options, and I do have some that are a bit more closer to sanity. So I'm not quite sure I'll play that. But again, let's say if you see the things run up, what I might do is I might cash settle one or two of my options that become more in the money, and then use that as fuel to start exercising my other options as they get closer and closer and closer. But either way, I am, from what I've read and from the little that I understand, speaking for myself, my play is to increase my GME position, but to do so using options. Oh, and the last thing is this too, Josh. As you recall, back was it the 28th, whatever, January 2021, end of January, they turned off the buy button. Phone calls were made. Nudge, nudge, wink, wink. And Robinhood's the best one, but there were others, of course, besides Robinhood that turned off the buy button for the stuff. I would expect the same nonsense to happen again. So with options, it is much harder to turn off the buy button with an option. So that's something to put in your back pocket.
Believe me, if this does play out, every single shenanigan in the book will be played. I mean, you won't buy, your brokerage will be turned down. I mean, everything that you could possibly imagine and more to fuck the retail will happen. And I'm not someone who's just a massive GME bull, but this is just the reality of it. I'm really not too much of a bull. I just see a potential opportunity of a lifetime.
It would be the realization of the fourth turning, financial crisis, as wealth is transferred from the older generation to the younger generation, because that's generally who's in GME. On like a bigger level,
it would most definitely crash the market if it plays out to the same extent that Justin believes it possibly could, which is just because just think about it. If there's a stock that has more people shorting it than actual float, and there's nothing that they can do, the stock could theoretically go to infinity. And I'm not saying it will, and I don't think it will. And if anything does happen, there will just be a government intervention and a bailout.
Phone numbers. The people aren't going to sell till they see phone numbers, for a single price for a stock. But here's the key thing: when it comes to GME, like the core thesis is this, and like if you're gonna bitch at GME, gammon, this at least bitch at it correctly and say, listen, people who are bullish on GME, it's not necessarily the company, although the company probably is going to turn around considering leadership. Let's just set that aside. It has to deal with a fundamental flaws in the way the market settles and reports short interest. It's been consistently abused by the big guys and the sophisticated players, and now they are finally getting caught.
Happening to the extent, and I'm not even someone who really is that confident that all of this is happening to GME. I am strictly playing it as pure gambling money. That is a lottery ticket. If it happens, it is a legit lottery ticket. So I'm someone who is in the position. Why not put, say, $2,000, $3-4 grand into this potential 100,000 bagger? Like that's just the reality of the way I'm looking at it. I'm not looking at this like Justin, who's a big real estate guy, and he's in the process of selling a house, who wants to put a lot of those profit into GME. Trust me, I'm not like that at all. I'm a very high skeptic. But
those are baseless allegations.
I don't want to miss out, so I'll have a tiny bit of money in there, and we'll see how it happens. Justin, any final thoughts?
One final thought. So this past weekend, you and I and many other very much more intelligent people were in Houston for a Rebel Capital's Live, and I had a really good conversation. Josh, you might have been there over part of it with Joseph Wang, and I point blank at Joseph Wang.
We will be interviewing Joseph Wang shortly.
Oh, yeah. And one of the questions I asked Joseph Wayne was like, listen, if there's some issue where the OCC, that is the Options Clearing Corporation, the NSCC, the National Securities Clearing Corporation, or DTCC, the parent of all this stuff, the Depository Trust Clearing Corporation, if there's some issue where these entities melt down, will the Fed step in and bail them out? And without hesitation, Wang was like, oh, yes. Yeah, absolutely. Absolutely. No doubt.
Yeah. I completely agree, but Joseph Wang actually worked at the Fed, and he was the person who did QE. So when you hear Jay Powell call up say on a press meet, no, we're going to do $120 billion worth of QE. Wang was actually the guy executing that. So he knows his stuff, to say the least.
Yeah.
All right, Justin, real make or break this month. So we'll see how it happens. We'll check back in during Moass